Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, December 27th, 2024. Happy holidays. Hope everyone is enjoying the holidays with their respective families. So, as always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will DOGE achieve will DOGE achieve significant deficit reduction? Say that 5 times fast. Our answers are DOGE is unlikely to achieve significant deficit reduction for 3 reasons. One, we are in a fourth turning that demands populist fiscal policy, not austerity, to narrow the historically wide income and wealth gap between the working class and us coastal elites. Number 2, Donald Trump, the most populist U.S. president since FDR, has already confirmed that his administration would, quote, never cut Social Security or things like that, and that DOGE is exclusively focused on, quote, waste, fraud, and abuse, which essentially reduces DOGE's remit to a narrow slice of the federal budget. And finally, number 3, the large categories of federal expenditures that DOGE is not focused on are growing quite rapidly due to demographic challenges and a general unwillingness of Congress, read the American voters, to make the sacrifices required to achieve significant deficit reduction. We were learned that Congress is in no mood for significant deficit reduction last week during the continuing resolution debate. All told, we think DOGE is a good thing for America and the world because any deficit reduction reduces the probability of total war associated with the potential loss of the U.S.'s exorbitant privilege, which unfortunately is a reasonably probable scenario that investors must consider as we trudge deeper into this fourth turning. Just because we think DOGE is a good thing and will achieve some deficit reduction does not mean we think it will be successful in achieving significant deficit reduction. Investors will be wise to note the difference before the bond market is forced to adopt our views like the raging bull equity, credit, and crypto markets did this year. For what it's worth, the nominal 10-year Treasury yield and 10-year break-even inflation rate are roughly 100 basis points below our estimates of fair value. Transitioning to our 42 macro dashboard, as always, we'll wrap up the question from our community. This one's regarding how will the Trump administration counter the strong dollar? So it reads, if Trump and DOGE really want to cut the deficit, they don't need to start with, don't they need to start with the interest on the debt? Luke Groman's suggestion of cutting the rates to zero and then refinancing the debt seems really plausible. We frequently heard Trump say we need to lower interest rates on the campaign trail, so he may have already been in talks with Bessent on this. Thoughts? Yeah, so our thoughts is, several thoughts, but I would say the starting point is to understand that the executive branch nor the Treasury Department, which is part of the executive branch, have any authority over the level of the setting of monetary policy. So investors need to be aware of that. There's obviously talk that we could produce, we may see a quote unquote Fed chair in waiting, if you will, in order to provide sort of forward guidance that extends beyond the current Fed chair's remit, which Jay Powell's is currently, his term is set to expire in May of 2026. So that's how you could potentially influence that from the executive branch. But at the end of the day, it's really not, it's more of a soft influence. It's not a hard power influence. If you think about the history of the Federal Reserve, every sitting president wants lower interest rates, right? Like it's similar to the economy, and it reduces the interest we pay on federal debt. So obviously lower interest rates is, ceteris paribus, a good thing for any sitting president. Now, being able to get it to cut interest rates to 0%, we disagree that seems really plausible. You'd likely need to see a significant contraction in the economy and a significant crash in and across asset markets in order for the Fed to justify cutting the policy rate, I'd say even beyond 4%, let alone to 0%, in the context of the resiliency that we continue to see in the economy and in the context of the stickiness and inflation that we already see without the advent of incremental tariffs or a tighter immigration policy that reduces overall labor supply growth at the margin. So those are all things that could potentially come down the pike as it relates to the setting of monetary policy, and some of it is obviously potentially could cause interest rates to go up, much like we saw with the Federal Reserve's policy pivot, if you will, last Wednesday. So I think we covered everything in the question there. So I guess the key takeaway is that the Trump administration is, I wouldn't say powerless to counter the strong dollar, but certainly one of the ways in which they can counter the strong dollar is to, get inflation down. And the simplest way to get inflation down is to significantly reduce federal expenditures and or implement policies that, improve the overall productivity level of the economy. I would, I think we can all agree that the some of the tax reduction proposals and some of the regulatory proposals that have been put forth by President Trump and incoming Treasury Secretary nominee Scott Bessent, those policies would be contributory to sustained elevated rates of productivity growth, which would be disinflationary. We will also see some cutting of federal expenditures via DOGE. Now, will they do enough of those things to offset the inflationary side of the policy mix is a open question. And, I don't think we know the answer to that currently, but I think betting on that is the issue. In the context of where we are in the positioning cycle. The market is positioned for the good stuff overwhelming the bad stuff, but the risk to asset markets as we go deeper into 2025, especially when we get beyond $750 to $800 billion of TGA spin down, we expect the first few months of the year. Once we get beyond that, it could be very well be the case that the size, sequence, and scope of the incoming fiscal and regulatory policy changes don't align themselves in a way that are particularly supportive for asset markets. And, I'm on record, in our research publications and now here saying that the smartest thing you would possibly do is if you're President Trump is to kitchen sink the economy and blame Biden in your first year of your term so that all the stuff that you want to get accomplished with respect to DOGE and deregulation and tax cuts, et cetera, those things kind of quote unquote save the day. And you will wind up with this raging bull market and very strong economy heading into the 2026 midterms and the 2028 presidential election. That's what I would do. So this is someone who's probably going to run for president someday, most likely. Assuming I don't get assassinated or something like that first. But that's neither here nor there. It's pretty dark to end on. So let's end on a happy holidays note, and hope everyone's having a wonderful holiday season with their family. We'll catch you back here on Monday. Cheers.